Hello everyone, welcome back to Stock Spy. Today we are breaking down Lululemon's dramatic pullback, why it's happening and whether now could be a smart time to invest. Spoiler alert, this is not financial advice, just a perspective to help you think more clearly about the stock. So let's dive in. In 2025, Lululemon stock has plunged aggressively, losing about 56% of its value year to date. This slide has taken the stock to a 5-year low. Why the tumble? It stems from several critical issues. The main being the repeated guidance cut. And this is the second time in 3 months the company has downgraded its full year outlook. There are tariff pressures, the removal of de minimis exemption and new trade costs are expected to hit profits by approximately $240 million in 2025. The slowing US demand and product fatigue, like same-store sales falling, and CEO Kevin McDonald admitting parts of their product range have grown too predictable and stale. Analyst sentiments reflects this uncertainty. Jefferies and others have downgraded the stock, with price targets falling as low as $150, signaling caution and possibly further downside. Still, there are reasons some investors see value. The valuation appears steeply discounted with a PE around 11 to 13, which is much lower than the industry peers like Nike. Intrinsic value estimates suggest upside. Some models place fair value around $342, implying a roughly 51% upside. Cash reserves and balance sheet strengths leave room to navigate through this slump. Bullish analyst outlook still exists. On average, analysts have buy consensus, with a 12-month target around 246, which is a 47% upside from current levels. International business remains a bright spot. International sales were up 15% even as US lagged, showing a global growth potential. So is this a smart entry point or a value trap? Let's break it down. The bull case. Stock is materially cheaper than before, possibly a discounted premium plan. Strong financials and growth abroad could support a rebound. If Lululemon can refocus on innovation, refresh its core offerings, and control costs, there may be a solid long-term gain. There is also a risk case where US demands remains weak. Tariff burdens are not going to go anywhere. Product lineup need revitalizing. Competitions from Alo Yoga, Viori, etc. are heating up. Analysts warns that nothing near-term may spark a turnaround. Jefferies' price tag at 150 reflects that skepticism. So what is the recommendation? If you are a long-term investor who believe in the brand strength, global expansion and a turnaround potential, this slump may present a contrarian opportunity. The valuation now appears generous and the intrinsic model and analyst targets hint at meaningful upside, with obvious caveat that recovery is not guaranteed. For short-term traders or those curious on ongoing macro pressures, waiting for a clearer sign of renewed growth or product momentum might be a smarter move. Another disclaimer, this is not financial advice. Please do your own due diligence before investing. So that's it for today. What do you think? Is it an oversold opportunity or a value trap? Drop your thoughts in comments, like and subscribe, hit the bell button so you don't miss the next breakdown. Till then, stay curious and see you next time.